Welcome, everyone, to the Directed IRA podcast with Matt Sorensen and Mark Kohler. We are delighted to be with you today, talking about what you can still do in 2021.
Yeah, or for 2021. Like sometimes it's too late. This is the one time where it's not too late. There's some last minute options here.
Yeah, because now what we're going to tell you is you're going to need some things here to do this, though. You're going to need a DeLorean, some plutonium. All right, you need to drive
Flux
80 miles
capacitor.
an hour, a flux capacitor. Then you can go back in time.
Yeah, maybe a lightning bolt. We're
Maybe
just
one, but no, you don't have to.
Oh yeah, that's true. That's old school. No lightning bolt needed. Okay. Well,
Right.
this is going to be good. So we're coming to you both live from Phoenix. It's just we're in different rooms for audio purposes. We've got a little studio we're building out so we can be, a little more legit with our news desk here in the next month or so for Directed IRA podcast. But for now, we're in two separate rooms. The lighting is questionable. I've got this. I need powder. I need makeup. Like we need makeup people because I can. There's a gleam off
Makeup.
Yeah. There's a gleam off, or what it was some sort of gleam off my forehead. So if I turn my head just like this, it's perfect. But I don't know if I can do that the whole show. So for those on YouTube, you're gonna have to deal with it. Okay. So Matt, we have got all sorts of goodies here, people. We're going to talk retirement accounts, Coverdells, HSAs. There's a whole list of things you could still do. Solo K, of course. Yeah.
Yeah.
Well, where do you want to start?
So for 2021, I think the good news is you still have time. A lot of tax planning, if you wanted to do stuff for 2021, tax deductions, things like that, you needed to do that in 2021. That's why we're joking about back to the future type stuff.
Yeah.
But you can actually still do IRA contributions. Let's just start with the easiest one first. A traditional IRA or Roth IRA for 2021. You have until April 15th.
Okay. So that's where you're going first. Okay. We're going to go there first. All right.
Yeah,
traditional IRA
up, or Roth IRA. Just we're warming up. We're on the court,
Okay.
Doing layups before we get to our jump shots.
Yeah. These are on the tennis court. We're just doing some forehands, just warming up. Nothing too aggressive. We're not going to rush the net. Now let's do the numbers. 2021 and 2022, the IRA contribution amounts have not changed. So there should be no confusion. It's $6,000 per person, $7,000 if you're 50 or older. Now there's some income limitations. So Matt, why do you want to take traditional first and tell people what?
Let me just give a general statement. On traditional, there's no income limit if you have no 401k at work or you have no 401k, but your spouse has no 401k.
That's good.
So where you can get tripped up on traditional IRAs is if you have a 401k at an employer or your spouse has a 401k at an employer. Then if you're high income, they restrict your contributions to a traditional IRA. And that's in the mid 100,000 range, approximately where you're going to be, where you might see some restrictions on contributing to a traditional IRA if you also have a 401k at an employer.
Yeah. And if you're single, that phase out is at 76,000. If you're married filing joint, it's at 159,000. Now, the thing to keep in mind here is that doesn't mean all is lost, because we want to open the door to the back door of the house. We want to leave it a little crack open there for you. And so some of you go, well, I have a 401k at work, so the traditional IRA doesn't make sense. That's a blessing in disguise, because what we really want you to do anyway is a Roth IRA.
Yeah.
So you say, well, I make too much money, or I have a 401k at work, blah, blah, blah. So what you do is you still open the traditional IRA, make your contribution. You're like, well, I'm screwed. I don't get a write-off, but that's okay, because you just snuck in the back door. And on day 2, after the party, you're going to wake up in the morning, and you're going to be talking to Jake in the kitchen about Samantha, after he rescues you under the glass coffee table for you 16 candle fans. And you're going to say, is it all over? And he's going to Jake's going to say, no, you can convert it to a Roth. Now you have a Roth IRA, you went in through the back door, you don't care about the traditional write-off anyway, and you still get your $6,000 or $7,000. That's the back door.
Yeah, we have entire podcast episodes on the backdoor Roth IRA. And last year there was some news about the backdoor Roth IRA being closed out. It was not. That legislation did not pass. So the backdoor Roth IRA is alive and well. You can do it for 2021 still up until April 15th, and you can do it for 2022. So, so if you didn't make any contributions in 2021 and you're thinking about doing it for 2022, you could actually put 12 grand in right now. So you drop 12 grand into your traditional IRA, even if you had a 401k at work and you hit those income limits, even if you didn't qualify for a Roth IRA to begin with, no problem. You're not taking a tax deduction. You're just doing considered a non-deductible traditional IRA contribution. Then, like Mark said on day 2, you convert it to Roth. Now you're over in the Roth IRA party. You got a Roth IRA with 12 grand in it. So,
okay. And there's no tax due, people.
Right.
A lot of you may say, well, I'm converting to a Roth, so I owe tax. You actually don't, because you didn't get a write-off to do it in the first place. Now, here's another little caveat. We'll be brief here, because like Matt said, we have podcasts on this whole topic, is that if you go, well, I'm going to do that. Well, the first question your accountant or we're going to ask you is, do you already have a traditional IRA? Yeah, okay. Well, you've got to convert that to Roth first before you can do this little backdoor thing. Well, the little side benefit there is you can convert that now or after April 15th, but you don't pay the tax until the spring of 2023. But if you want to do the backdoor Roth for 2021, you've got to get that traditional contribution in before April 15th. Now, Matt, there's an idea. You could actually make the 2021 traditional contribution non-deductible by April 15th.
Yeah.
And then wait a little later in the year and then just do the conversion in kind of a 2-step process. Convert the old IRA first, then convert this new backdoor traditional later, but do it all in the same year. I guess, right? I mean, you could.
Correct. You could, yeah, you could wait. Yeah. So, because you could always make the non-deductible traditional contribution, but the conversion, right, there is an ordering rule, and the ordering rule is you have to convert deductible traditional IRA dollars first, and then you can get to the non-deductible one. But you still, if you do it now, like March 3rd right now as we're recording this, by April 15th, you got time, get it in.
Now, here's another fun little strategy. I'm going to throw this out. We had this adorable grandma last year that was at our crypto tax summit. She was the oldest attendee, and she's trading crypto. Loved her. She was so fun. And she said, well, I'm older. I got enough retirement, but I want to help my grandkids really jumpstart their Roth IRAs. So instead of gifting them money or trying to help them form a Roth IRA and go through all those headaches, she said, I'm just going to fund my own Roth IRA for $7,000, and I'll create a number of beneficiaries. So if I had 7 grandchildren, I could have 7 beneficiaries of my Roth IRA. And so some of you may be thinking, well, I don't need to do this. Whoa. Well, do you want to leave some sort of legacy here? This could be a legacy strategy before April 15th. So you can still do a Roth IRA before April 15th, but make the beneficiaries someone down the line.
Yeah. Like Matt Sorensen.
Yeah.
Whoever, whatever name pops up for you, that's cool. If there's not one that comes to mind, just drop down Matt Sorensen.
Okay.
Okay, so let's hit Roth IRAs because we just talked about the backdoor Roth. Let's just talk about that just for a moment.
Okay.
So again, you still have until April 15th for 2021 contributions. You can throw in your $6,000. You have to have earned income, of course. Remember, you got to have earned income. A lot of people like to do them for their kids too. Does your kid work in your small business? Did your kid have a summer job? Help your kids out in getting some money in a Roth IRA.
Let's stay with kids for a moment, if we could. So if some of you say, well, okay, I can put money into my kids' Roth, not Kid Rock, that's a different topic, but I can put money into my kids' Roth IRA before.
Kid Rock has enough money.
Yeah. Now, what was interesting is last year I had a client that said, well, my teenage daughter, she's 16, I want to put money in her Roth IRA, but I never paid her out of my business the way I should have. I never transferred money to my daughter's name. So out of my business, the proper method. We talked about, we got shows dedicated to that. And so he said, she doesn't have earned income. She didn't have a side job. So I guess I can't do a Roth. And I said, whoa, whoa, whoa. Did she have babysitting income? And he said, yeah. I go, well, how much did she make babysitting last year? And he said, well, oh my gosh. I mean, she was making sometimes $100 a week. And I go, well, $100 a week times 50 weeks, that's $5,000. He's like, oh my gosh. So she could claim $5,000 of income for babysitting last year, whatever that was. She could say, I got paid under the table, but I'm going to claim it. So maybe it didn't even go through a bank account. That's okay. She's going to step up to the plate, be an honorable tax-paying US American and say, I made $5,000 babysitting. Now dad can say, boom, we're going to throw $5,000 in your Roth IRA for last year because you had earned income of $5,000. You don't have to have a W-2 to say that. So,
yeah. Awesome. Okay. All right. So now there is a phase out. I think the Mark J. Kohler calendar has that in there for Roth IRAs. Is that what you're referring to?
Yeah, that's what I'm referring to. Everybody keeps saying,
I got mine hand delivered. You have mine, right?
Yes. Kind of.
Okay.
Kind of. Okay. So comes tomorrow. There was a packing malfunction. So there's another suitcase coming in.
This is code for Mark forgot.
That's a little strong. I don't know if I appreciate that comment.
You prioritize other items in your packing.
Let's look at the glass half full. I put your calendar in my car. I mean, I remembered to do that.
Okay.
It just didn't make it to the suitcase when I was in the parking garage at the airport. So
okay.
There's another staff member bringing yours tomorrow. So it's okay. Okay. So here's the phase out for Roth IRAs. If you're single, this is for last year. If you made more than $140,000 single, then you can't just directly do the Roth. You got to go back to the back door. And if you're married filing joint, it's $208,000. Now, this doesn't depend on whether or not you have a 401k at work. This is just the rule for Roths, period.
Yeah.
So just know if you make more than 140 single, 208 married filing joint, you're just going to do the back door. That's all. Don't stress out. Now we have articles on those of you that are like, well, I already funded it and I made more than that last year. Well, there's a process to unwind that. We're not going to go there today, but you want to make sure you're on top of that.
Yeah. Okay. All right. So we got the traditional IRA and the Roth IRA done. Now, one question that typically comes up is, well, what if I file an extension till October 15th on my return? Do I get more time to put more money in my traditional IRA and Roth IRA? Negative.
Yeah.
Nope. So, and there are some other ones you do get more time when you file an extension. We'll talk about those here in a moment. But for the traditional and Roth IRAs, it's April 15th every year.
And for your kids, same story. If you're going to contribute and make, grandkids beneficiaries, same story. All this IRA stuff, the buck stops at April 15th. So just know that. Okay, well, why don't we stay? Do we want to stay with April 15th or do we want to stay with this retirement plan stuff? That's a tough one, isn't it?
Yeah. Let's stay with retirement plan stuff.
Okay.
Let's stay with retirement. So then want to hit Soul, okay, maybe?
Well, maybe
or SEP IRA?
I would say the gateway drug to the solo 401k could be the mega backdoor Roth.
Okay.
So we're kind of still talking Roth.
Okay.
Maybe.
All right, go for it.
I don't know. So some people say, well, Mark, $6,000 in a Roth, that's cool. But I've heard about this mega backdoor Roth thing. Can I do more Roth money? Yes, but that means you have to involve your 401k strategy. Now, some of you may have a 401k at work. Some of you may have a solo 401k in your small business. Both can be used for this mega backdoor Roth, but I'm just going to say, oh boy.
I think you're toast on the mega backdoor Roth for 2021.
Yeah.
So for those of you that were wanting the mega backdoor Roth, that's requires an employee contribution, which usually has to be on your W-2. And that deadline was January 31st.
Yeah. But for some of you that are going to do a company match, you could you could do that after if you file an extension by March 15th for your S Corp or April 15th for your LLC sole prop. the company match could be converted to Roth later in the year. So let's say that. Okay, so the mega backdoor Roth is kind of a half mega backdoor scenario for 2021.
Yeah, you can have fully mega backdoor for 2022.
Yeah,
but you're only get the half. You're gonna get the 6-inch for you're not getting the full foot long.
But the foot long subway. Yeah, you're out. Jared would be very disappointed. I can't believe I remembered his name. Remember the mascot for Subway? I guess that's kind of a.
Jared did some bad stuff, I think.
Yeah, he went downhill. We should not bring up his name. Okay.
Yeah.
Okay, so
Subway does not want to be associated with him anymore.
No. So what I would say to any of you out there that are saying, I want to maximize how much money I'm putting in my Roth for 2021 or 2022, I still think you want to have a conversation before April 15th. Talk to your tax advisor and go, is there anything I should do before April 15th? But you're going to involve your 401k, which like I said, is kind of the gateway to this conversation. So Matt, what is our deadline for those that have a solo 401k? Because your employer 401k is already over. You either got match or you put money in. This is the entrepreneurs.
Yeah, for those of you self-employed with no employees, that's the awesome solo case strategy. We have a whole podcast on that. But the cool news, the first thing I want to make sure everybody knows is you can still set it up for 2021. This is new from the Secure Act. This is new laws that came out in the last few years. You can still set it up for 2021 today in March before your tax return deadline, and you can still make your employer contribution. So let's say you paid yourself $100,000 last year in your S Corp, okay? And you're like, man, I want to do a solo case still for 2021. I want to take that right off, do some traditional dollars. Cool. You can put, if you made $100,000, you can put 25% of that in as an employer contribution, put $25,000 in, and a $25,000 tax deduction right off on your corporate tax return. Will go off on your 1120S as a company retirement plan contribution. And now you're in the game for 2021. You got 25,000 bucks in, and you got a tax deduction too for 2021 as well. So the deadline on the employer contribution is the company return deadline. Okay, which I think is March 15th for S corporations.
Yep.
And then of course you can also extend that too.
Yeah, to September 15th. And so you've got, so when some of you are thinking, oh my gosh, I better make a contribution to my 401k, or I've got to do my company match before April 15th or March 15th, as the case may be, if you have an S Corp, don't worry, just file a freaking extension. You're okay. So make sure you follow those steps by March 15th, which we're right around the corner. I mean, we're just 10 days away essentially. And so get on that.
Yeah.
And some people say, well, I've never filed extensions before. Oh my gosh, I'm going to get audited. No, it's quite the opposite. You actually reduce your chances of an audit by filing an extension. Don't be the first one in the door. It's kind of like, you're the first one the IRS is going to grab when they come in. Oh, here's a nut job that wanted to get his return done. Let's grab him. We got nothing better to do. You want to be the last one through the door, where later in September, they're like, we're already busy enough. I don't want to audit anyone else.
It's like showing up at a crime scene. You don't want to be one of the first 2 or 3 people showing up. The cops are looking around like, was this you're doing here? You want to get there once there's like 1,000 people that showed up to look and see what's going on.
You're like, you just want to blend in. You want to blend. Yeah. And that's a Jason Bourne strategy. You just blend,
Yeah, just blend.
Blend in. Don't be the first one through the door. Now, as an aside, some of you may say, well, isn't this new rule for 401k matching similar to a SEP, the self-employed pension strategy? Now, I would say yes, but we're not a big fan of the SEP, because as soon as you do the SEP, you realize this year, I'm going to want the solo 401k because the contribution amounts in conjunction with your payroll in an S Corp are so much better. So it's kind of like, I'll do a SEP or I'll do this solo 401k match only, just as a Band-Aid. Then in 2022, you're going to get your crap together and do it right. So, but don't worry about April 15th for that strategy.
Yeah. And on the solo K, again, you can still set it up in right now for 2021, even though we're into 2022, still get your employer contribution in, which can be pretty significant. If you're a sole prop, it's 20% of your pay. And you can debate whether you want to do an employee contribution on that. There's some differing opinions about that. We have some articles on it. But just know your employer contribution is still good up until the company return deadline plus extensions.
Yep. Now that, if any of you are like, well, oh my gosh, I want to get that done, we can still do the solo 401k up until September 15th with an extension.
For 2021. We are still doing it. I mean, every day we're probably setting up a solo K for a client.
Who should they call? Who should they call?
Call in the law firm, get to KQS Lawyers, and you can talk to Christy or Kate. They're the solo 401k paralegals. But also, you get with the schedulers and you get with one of our attorneys. They can go over the solo 401k before you do a consult with it. So we can take care of you and make sure you get the plan set up properly for 2021 and contributions in as well.
Okay. Now let's get back to April 15th, because there are some other wonderful 2021 strategies that expire come April 15th, and an extension does not save you. Let's grab, should we do the Coverdell or the HSA? You choose.
Let's do the HSA.
Okay.
All right.
I'll do a general intro, and then you can take it to the hoop. I'll do the alley-oop portion. I'll throw it from half court. You got to get your hops. Be ready to grab it.
Okay. I hope I don't miss it. Okay, keep going.
Okay. All right. So the health savings account, people, if you had a high deductible plan last year, and the rule for a high deductible plan was that if you're single, you had to have at least a $1,400 deductible with a max out of pocket of $7,000, or if you were married, it was $2,800 deductible, a minimum deductible. So, and a $14,000 out of pocket. If you had a plan like that, and a lot of times the health insurance companies are going to tell you you're HSA qualifying or not. But if you had a plan last year that qualified, whether you had a small business or not, no matter how much money you made, there's no phase out. And super easy. You have until April 15th to do a contribution for last year and get a tax deduction on the front page of your return. Again, you can make $1 million and still take this write-off. And the write-off for last year, if you're single, it was $3,600. And if you were married, it was $7,200. Now we have a self-directed HSA at directedira.com. And we have a self-directed crypto HSA. So you can choose either one. Oh, and Matt, do you know what I've got right here? I'm going to just show it here on the podcast.
All right.
So last year, now Matt's going to take it to the hoop with any final points on that. But last year I took my HSA literally at the same time of the year. It was literally in March of last year. Yeah. I contributed to my HSA for 2020, and I went out inspired by the series Yellowstone, and I bought my cows. I bought 5 bred cows in an HSA owned LLC called the Kohler Dutton Livestock Company. Legit, totally not kidding. And those cows had 5 baby steers. Well, calves. They turned into steers later in the summer, in a very tragic day for them. And then my cows got bred again. And so I sold my 5 bred cows and 5 calves a month or so ago, and I got the check right here. See, I got to be careful. I want to cover up some of the account numbers here on Zoom. But here's my check, $13,900. I bought the cows for $11,500. I got them on a report here somewhere, and I made $13,900. So it was about a 20% rate of return in a 9-month period in my HSA buying cows.
And you got to, kind of play cowboy a little bit. Be like, yeah, I got livestock.
Yeah. How's your livestock?
I got cattle.
Yeah.
Now, no one can say this to you. No one can say you're all hat and no cattle. You're like, I actually got some cattle.
Yeah. So when you're at Denny's in the morning in small town, they're like, how's the herd? You're like, they're all right. Yeah, I can respond. Yeah. All right. So I actually cared what hay prices were for the first time in my life. So it's a weird time. Yeah. Okay. So that's generally how the HSA works, but
yeah.
What do you
think?
This
is another one that's an April 15th stickler. All right. if you haven't done it for 2021, you have until April 15th. Now you had to have the high deductible plan back in 2021. There's some deadlines. I think you had to have it by November-ish of 2021 for it to count. But you have until April 15th. It does not include extensions though. So even if you're extending, don't think you're buying yourself more time. Get this one in now. If you want to get the tax deduction for 2021. And like Mark said, when he said it's above the line, this is also important to know. Even if you don't itemize on deduction, you just take the standard deduction. You still get this on top of it.
Good comment.
So it's and plus just remember the HSA. I'm like, why isn't everybody doing this?
Yeah.
It grows tax-free and it comes out tax-free for your medical. And
Anytime.
you're all going to have this medical, especially as we get older in life.
Yeah. But you don't have to wait till you're 59. You can do it.
Yeah, right. That's right. Yeah. Yeah, you can absolutely. I mean, go to the dentist and, prescription drugs, whatever you got going on.
Yeah, I know. It's crazy. Recently, Matt got some special medication that is tax deductible through the HSA.
I did not. And that's okay if I did. Okay. It's just, some people may call it a performance enhancing drug. Whatever. If everybody's doing it, is it illegal? I don't know.
What are you talking about? I was just talking about your blood pressure medication. I don't know what you were talking about.
I mean, I don't.
Anyway, all right. Fun. Okay, now the Coverdell. Why don't you explain the Coverdell? Because Matt and I think we're the only ones in the country that are talking about the backdoor Coverdell. We literally created documents that did not exist for this strategy. So Matt, I'm excited.
So yeah, the Coverdell is cool, and you can self-direct your Coverdell. Even we have clients with crypto Coverdells for their kids. But yeah, your Coverdell, you can put it in $2,000 a year. Now, you're not getting a tax deduction though on the Coverdell. That's one to keep in mind. You're not going to get a tax deduction on the Coverdell, but it does grow, and as you're investing it, you pay no taxes on the gains you're making, and it comes out tax-free for college education expenses for your kids or grandkids.
Yeah.
So the Coverdell is important. Again, you can throw $2,000 in, and
per year, but April 15th.
Per year. Yeah, per year. You got till April 15th. And now there's some rules on that. Maybe Mark wants to hit those in terms of who's the responsible person on the account, usually the parent, and who's the beneficiary, usually the child, but who's the depositor? That's where there's some tricky rules, and you have to look at some income limits.
Yeah. And another term that I would just want to say this so everybody can wrap their head around it is think of it like an educational IRA. It's just for education. It's for your kids. But if your kids don't use it, you can change the beneficiary as the responsible party to another child or even a grandchild. And so you can keep this in the family and keep bumping it down the road if your kids don't use it. But you're not the donor. You didn't put the money in. You're just in charge of it, which is super cool. Yeah. Now, the reason why we worry about you being in control but not the donor is government said, oh yeah, these are really nice, but rich people, you can't do it. And you're like, damn, geez. Okay. And it's not that rich. The Coverdell phase out for 2021 and 22 is actually the same. It's 110 grand if you're single, 220 grand if you're married filing joint. So if you make more than 110 or 220, you can't fund an educational IRA for your kids. You go, well, I'll do the 529. FYI, they suck. And if you want to argue with me, I will all day long. The rates of return in those are terrible. Who knows what the costs are that they're charging inside those things? And you have no control over the investments. Watch out. And I get hate mail for that statement, but I do not care. And you're like, well, you put 50 grand in a 529. Yeah, I can put 50 grand in a slot machine too, but what the hell? I'm not going to go do it. Jeez, I'd rather put 2 grand into something I can control.
That's a good one. I like that one.
That's a new one. That came to me.
That was a good one. The slot machine.
Sometimes
I don't know the odds. That's a good one.
Sometimes my juices get flowing.
Yeah.
Okay.
I'm gonna steal that one though. That's, you know, the good ones I steal. The bad one, I'm like, yeah, I'm taking that one.
You know what's fun in mine and Matt's relationship? Whenever Matt comes up with a good joke, I pretty much steal it and use it. And whenever I come up with a good one, he pretty much steals it and uses it. So we never really use our own jokes ever again because
It's half Mark Kohler material, half Matt Sorensen material.
Oh my gosh. Okay.
Right. Well,
So
here's the
on
thing.
the back door. Yeah.
Yeah. Okay. So there's kind of two different back doors, depending on which one you want. Or maybe there's a back door and a side door. I don't know. You choose.
Okay.
So let me say you got a teenager you're looking to do this for. Well,
okay.
Because what the IRS looks at is who's the depositor in this account. And well, the depositor could be your kid.
That's true.
All right. Maybe you got a teenager that has a bank account, pay them some money. They can deposit that in. Now they're the depositor in their own Coverdell. You're the responsible person because you're the adult on the account. They're still a teenager. And so that's probably like, I don't know if that one's the side door, but that would be one to do if you have teenagers. Now, if you got a 2-year-old, they can't have a bank account. You're not gonna be able to get this through an account that they own that can actually legitimately make the contribution. So, but I do like it for maybe your teenagers. I think that's an easy way to do it, is run it through your kid's bank account.
Yeah. Now, this gets so good, everybody, because here's a few side notes. We're just talking about gifting at this point. Matt is what I think Matt's alluding to is you could gift money to a teenager or gift money to a 2-year-old, which you can do, and they can make the contribution.
Yeah, because it doesn't have to be earned income. That's the other thing. A Coverdell does not require earned income. Neither does an HSA. All the traditional Roth, solo Ks, all those require you to have actual earned income, but the Coverdell is not.
No, but let's think outside the box. Do you get a tax deduction when you put the money in a Coverdell? No, it just grows tax-free and comes out tax-free for education. So what if I were to pay my kid for working in the business and I paid him enough or her enough to fund their Roth IRA and a little extra to fund the Coverdell?
I like it.
Now I'm getting a tax deduction in my business for them serving on the board, helping with the business. And I just funded the Roth and the Coverdell with a tax write-off. We'll go side door. So that's the side door. So you're kind of paying your kids, and you could have a 2-year-old on payroll. There's a lot of people that will push the envelope with some modeling issues if they have a business based on children, maybe a pediatrician. I'm not a pediatrist, a pediatrician. I'm a pediatrician. They probably exist. A pediatrician, or we've got some clients that sell children's clothing online. And so they literally use their own kids as models, and that's legit. So anyway, but the point is get a legitimate payment to your kids, take a write-off, then fund the Coverdell. So that's the side door. I love that, Matt.
Yeah. Okay, cool. Now, what about the back door? What if you got like the 2-year-old? All right. You're like, I can't get a bank account for them. Well, what about grandma and grandpa? Are they, making $220 a year now? Maybe you give them the $2,000 and let them be the depositor contributor into the account.
Yeah. And you can gift this year in our handy dandy calendar, new for 2022. Now, remember, this is a 2021 contribution by April 15th, but you're gifting the money to grandma and grandpa in 2022. So the gift amount is $16,000 this year. So $2,000, easy schmeezy. But let's say you have 3 kids and you're going to do $2,000 a kid. That now it's $2,000 per child, not $2,000 per donor. So if you had 3 children, the most you could put in would be $2,000 each. That's $6,000 for last year, and then $6,000 for this year. You can just go back to back. And these could be crypto Coverdells, and you're like, crypto's down right now. We know it'll run again. We don't know when. So let's just get that money going. So we could gift
or whatever investments you like.
Whatever you like. We're not advocating. We got to be careful. Now, but it could get better. Instead of gifting grandpa and grandma, maybe grandpa and grandma serve on your board of directors. Now you give them a 1099 for serving on the board for $6,000. They turn around and pay the grandkids for helping come work on their rental property, or maybe they just pay the tax on the $6,000, or maybe they're lower bracket than you or whatever. But, grandpa and grandma love to get a 1099 in the mail at Christmas time. It's an extra gift to put in with this, the popcorn sausages. Kind of put it in the Hickory Farms box,
Yeah, maybe the Harry and David pears. Maybe soften the blow a little bit. There's some juicy pears too.
And a 1099
while you open up this 1099.
Yeah, you wanted to help the grandkids. Here's how you can do it.
Yeah, it's like, thanks for all that advice you gave me about my business. for serving on my board of directors. Here's a 1099, but you can't keep the money. You got to put in the kids' Coverdell. Now, I mean, we're joking about this, of course, but a lot of clients do this. They like to do this. They like their family involved.
Yeah.
A lot of families involved in their kids' businesses, and giving them advice and helping with other aspects of it. And they want to help the grandkids too. So, anyway, so we're joking about it, but it's a cool strategy. Just, I think the important thing to know is, there is an income restriction on the depositor, but if you're high income, there's two ways around it. If you got a kid with a bank account, just get the money over to them, let them be the depositor. And then, or think about grandparents or other family members, brothers, sisters, other people that could contribute into this for your kid.
I love it. Well, when it comes to April 15th, I'm looking at the handy dandy calendar, which you can still get at markjkohler.com before we sell out this month. There's no other major contribution deadline issues for April 15th. I would just say March 15th coming up, you've got extensions due for S corporations, and that's LLCs taxed as S corporations. And those are LLC partnership returns too, 1065s. They're now due March 15th. So if you have an LLC with multiple partners, that extension's due March 15th. You might have, now since we're on the IRA podcast here, you might have an IRA LLC with multiple partners. Well, the 1065 tax return is due by March 15th unless you file an extension. Now, if you have the UBIT issue, another topic many of you should be aware of if you're a listener of the show, that's a 990T that's not due until April 15th. But you got your 1065 due March 15th, your S Corp due March 15th. If you're going to fund a 401k inside an S Corp or a SEP, you got to file your extension. Then we turn the corner into April 15th. Any thoughts, Matt, on that? As I mentioned, deadlines.
Yeah, no, I think those are all the deadlines. I mean, I think the other just note I've had, and we've made this a couple times, is you can double up on 2021 and 2022 contributions right now. So you can get, for the IRAs, of course, you get 6 and 6, so that get you 12. Same thing with HSA and your Coverdell. Double them up, just get the money in, get it done. Also, you can do a solo K and a backdoor Roth IRA. You can do an HSA. You can do a Coverdell. You could kind of get the grand slam if you want and do all these things. Yeah. It's not like choosing one or the other. It's just find the ones that fit for you. But if you really want to do some strategic tax planning and saving, you can do all of them.
I'm going to give you, everybody,
supreme pizza, everything.
Yeah, no, I love it. What do they call it when it's like a really cool strategy? It's called the breakout, or no, you're unlocking an extra strategy that's really good. It'll come to me here in a minute. But hack. I'm going to call this the HSA hack.
Okay. All right.
Ready, everybody? This is good. Now, for some of you, I'm going to leave you with this strategy. If some of you say, well, I'm going to do an HSA for 2021, and let's say you and your spouse are between ages 55 and 65. Well, you get a $1,000 makeup contribution. So you may say, oh, hey, honey, hubby, wife, let's make our $7,200 contribution for 2021. And we can put in an extra 1,000 because we're both between ages 55 and 65. So let's throw in our 8,200. Well, the hack is, if you're both between 55 and 65, don't do a marital HSA, do 2 single HSAs, because you each get $1,000 makeup. So you're leaving $1,000 on the table. So you could do one spouse does a 3,600 plus 1,000. Now we're at 37. And the other spouse opens their single HSA. Now we're at 37. And so,
46
and 46.
Carry
so
the
now,
zero.
Yeah. Sorry.
CPA here.
Yeah, sorry. Put the 1,000 in the wrong column. So now I'm getting 46 times 2 rather than 7,300. And so that's a really powerful instead of 82. So
I didn't know that one. Man,
is it
like that? Learning new stuff. See, even I'm learning new stuff on this podcast. That's great.
Well, thanks. I appreciate that. Yeah, the HSA hack. So those between 55 and 65, don't leave that extra 1,000 laying around. So
cool. All right, love it. Okay, well, I just want to make a couple notes of some things. One is the self-directed IRA summit. If you're like, ooh, I need to learn more about these accounts and self-directing, or you've been doing it a while, you want to get more pro at it, we got the self-directed IRA summit. It's in Costa Mesa, going to be in Southern California, April
21st and 22nd. And if you
21st, 22nd.
Yeah, I got my calendar. So you don't have a calendar yet.
I know you've been withholding it on me. It's like this unfair advantage.
Tomorrow's your day. You
okay,
can unwrap it tomorrow.
Like Christmas.
Yeah. Now, for all of you tax professionals or legal professionals that catch our podcast, the summit is CE qualifying. So continuing education credits. So you'll get 6 hours per day. Well, we're only going to do a half day on the 21st, essentially. Probably
we're going to do a couple hours on the 24th, just a little pre-session to kind of set some business and tax planning rules, go over the trifecta and how you get money in the retirement account. And then Friday is just full-blown self-directing. We'll have a little breakout time, and there'll be some social. We'll have a couple of networking events, some cocktail receptions. Obviously, we'll have lunch. There's a VIP option, which is almost sold out. So if you want that, make sure you get on that. But yeah, it's going to be awesome. And it's only a couple months away.
Yeah. For those that went, I did my business owner workshop in November at this location in Costa Mesa, and the hotel is so nice. I mean, and who doesn't want to be in Southern California in April? I mean, it's just gorgeous. This hotel, we have lunch outside. It's really, really nice. So, come check that out. You can get to directedira.com and sign up, or at Matt Sorensen.
SDIRA Summit. Yeah, we have the website, SDIRASummit.com. SDIRASummit.com. That's where you want to get to.
And there's links on all of our homepages, I guess what I was referring to, but SDIRASummit.com. Okay, well, Owen, we got our crypto tax summit coming up in May. So all of you crypto investors, so be looking out for that, May 19th and 20th. That's on the newsletter. Thanks, everybody. Boy, exciting. Lots of deadlines.
Yeah, thanks, everyone. Stay calm, self-direct on.
See you next week.